Hi everyone, my name is Rene Gonzalez, a senior compliance analyst for the Ward & Brown General Agency. At Ward & Brown, we partner with health insurance agents to simplify access to better health options for employers and their employees. Today, we're going to talk about the basics of the Affordable Care Act, and we're going to start this video by going over the Affordable Care Act's employer mandate. Under the ACA's employer mandate, applicable large employers with 50 or more full-time and full-time equivalent employees are required to offer affordable health insurance coverage that provides a minimum value and a minimum essential coverage to substantially all full-time employees and at least minimum essential coverage to those full-time employees' dependent children up to the age of 26. A few housekeeping items here. Whenever you hear me say the ACA, I'm referring to the Affordable Care Act. If you hear me say ALE, I'm referring to an applicable large employer. If you hear me say FTE, I'm referring to a full-time equivalent employee. If you hear me say FT, I'm referring to a full-time employee. So let's go over a few of these terms that we just went over on that last page. So what is minimum essential coverage? That is the type of coverage an individual needs in order to meet the individual requirement of the ACA. That includes job-based medical coverage, individual market policies, Medicare, Medicaid, CHIP, TRICARE, and VA coverage, but it does not include vision-only or dental-only plans, workers' comp, plans that offer only discounts on medical services, or coverage only for a specific disease or condition. What is minimum value? A plan provides minimum value has an actuarial value of at least 60%, meaning the plan pays for at least 60% of covered benefits. Think of a bronze or a better level plan. As you can see from the chart here, when you work your way up from a bronze level plan up to a platinum plan, each different tier covers substantially a little bit more of the covered benefits in network. So how do you determine if you're an applicable large employer subject to the ACA's employer mandate? Well, there's a calculation that needs to be done on a yearly basis. We suggest doing it on January 1st, but it does not have to be done on that date. We just suggest doing it as early as possible in the year, since the calculation is done by evaluating the employer's group size in the preceding tax year. So on or around January 1st, for each month of the preceding calendar year, you want to total your number of full-time employees, add your number of full-time equivalent employees, and subtract any number of employees covered under TRICARE or VA on a monthly basis. That will give you a result for each month. Once you get a result for all 12 months, you want to divide that number by 12 to get your average group size in the previous calendar year. If that group size number is 50 or more FT and FTE employees, you are considered an ALE subject to the ACA's employer mandate, and that number is locked in for the entire year up until December 31st, regardless of any fluctuations during the year. So you may even dip below that 50 number during the year, but if your group size count at the beginning of the year was over 50, you are considered an applicable large employer until the following calendar year. Some important definitions when we're talking about this ALE calculation. Under the ACA, a full-time employee is considered someone that averages 30 hours of service per week or averages 130 hours of service per month. You have to use this definition when defining full-time employees for this calculation, even if that definition may differ for what you may consider a full-time employee in your organization. That could be up to 40 hours a week, 30 hours a week. The IRS says use this specific definition when making that calculation. What do I mean by hours of service? Think of hours paid. That's hours worked, paid time off, sick time, paid jury duty, etc. Payments under workers' comp or state disability do not count as payments for this purpose. Seasonal employees, they have to be counted if they are employed for more than 120 days in the calendar year, and if they average 30 hours of service per week or 130 hours of service per month during their tenure. What is a full-time equivalent employee? Well, think of all your non-full-time employees based on the IRS's definition. So that's anyone that worked at less than 130 hours. These are basically part-time employees, right? So what you want to do is you want to total all your part-time employees' hours of service and divide by 120 on a given month. Each 120 hours accumulated by a part-time employee in a month counts as one full-time equivalent employee. For any employee in that part-time employee space that provides between 121 and 120 hours of service in a month, round those down to 120 hours. This is to prevent a part-time employee being counted as more than one full-time equivalent employee. On the Word & Brown website, we have a really nifty calculator that allows you to determine your full-time equivalent count by adding up your part-time employees' hours on a monthly basis. The real cool thing about this calculator is there's some logic built into it. If you try to enter a value that's more than 120 hours, it will tell you, hey, that can't be done here. The rules say to round down to 120, and it won't let you enter any value above 120. So it'll prevent any of those one part-time employee being counted more than one full-time equivalent employee. We also have a really great group size calculator on the Word & Brown website. It allows you to enter your data on a month-to-month basis from the previous calendar year, and it will do the calculation automatically and tell you whether you are or not an applicable large employer based on all these factors from the previous calendar year. Another consideration to make when doing this yearly ALE calculation is IRS Controlled Group rules. Groups that share common ownership, enough common ownership, may be considered one employer by the IRS. These are what's known as control group or aggregate group rules. So you may be a business owner that owns multiple entities. Let's say you own 3 businesses. One is 10 employees, one is 15 employees, and the other one's 150 employees. Just looking at it from a high level view, only one probably looks like it's an applicable large employer. But if there's enough common ownership, the IRS says, no, we need to count that as one employer for the purposes of this calculation. So you need to total the number of each organization together when making this calculation. Now, this may be true even if if the separate entities have separate tax IDs, or they have different groups of employees, or in different locations, or in different industries. The determination is based on common ownership, and this determination should be made only by a CPA, a tax professional, or legal counsel that specializes in these kind of determinations. It's a really complex determination to make, so I don't recommend doing it in-house. Get a signed statement from one of these professionals saying whether you are or not considered a control or aggregate group. These rules can be found in the Internal Revenue Code, section 414, B, C, M, or O. Now, let's say you do have separate entities that are considered a control group. It does not mean they have to be under the same group health plan. It'd be a lot easier if they were, and if they qualify to be under the same group health plan, to do IRS reporting, but it's not a strict requirement to do so. What about the large and small group market? I know we've talked about applicable large employers under the federal market, under the federal rules. We know what those are, but we know that there's a small and large group market in each state. So we're going to talk about what the impacts are in terms of applicable large employer status and small and large group market in Nevada and California. In California, in the small group market, you're considered in the small group market if you're an employer with between 1 to 100 full-time and full-time equivalent employees. So you could be a small group employer in the small group market and be a non-ALE if you have less than 50 FT and FTE employees. You could be in the small group market and considered an ALE if you have between 50 to 100 FT and FTE employees, or you could be in the large group market and consider an ALE if you have 101 or more FT and FTE employees. In Nevada, you're considered in the small group market if you're an employer with between 1 to 50 FT and FTE employees. So you could be in the small group market and be a non-ALE if you have less than 50 FT and FTE employees, or you could be in the small group market and be considered an ALE if you have exactly 50 full-time and full-time equivalent employees, or you could be in the large group market and consider an ALE in Nevada if you have 51 or more FT and FTE employees. We talked about a requirement under the ACA's employer mandate is to offer affordable coverage. So how do you determine affordability? Well, affordability is based on one of 3 safe harbors: an employee's rate of pay, which is going to be their hourly wage multiplied by 130 hours as of the first day of the plan year, and that calculation is locked in until the beginning of the next plan year, unless that employee receives a decrease in pay. It does not change if they happen to have an increase in rate of pay, though. The W-2 box 1 income for the tax year, that's a second safe harbor. That pertains to the entire tax year. So right now we're at almost coming up to the end of 2021. So if we want to make an affordability determination for 2021, we have to wait until we have our W-2 data. That's usually somewhere at the beginning of 2022. That will allow you to look back on the entire year and determine whether or not it was affordable based on their box one income. This is a really good safe harbor to use to look back on, just in case you might have missed an affordability determination based on the rate of pay or the federal poverty level. That's a good backup option for employers. The federal poverty level, that's the last safe harbor here. And the regulations say that employers can use the federal poverty level as of 6 months prior to beginning of the plan year, since the federal poverty level guidelines aren't published until mid to late January in a given year. That helps employers in the October, November, and December renewal season determine affordability based on the FPL if they want to do so, since those regulations don't come out till the early in the following year. All these determinations for affordability need to be based on the lowest cost self-only coverage offered by the applicable large employer that meets minimum value. It's not always necessarily what the plan the employee enrolls in. So they might enroll in employee and family coverage. You still need to make this affordability determination based on that self-only rate. Dependent and spousal cost is not a factor in this calculation. We have a great calculator on the Word & Brown website that allows you to determine affordability based on the rate of pay or W-2 safe harbors. We break it down based on whether or not that is an hourly or salary employee. And also even further, we break it down based on whether the employer contributes on a whole dollar amount on a monthly basis or a percentage basis. So what happens if you, the applicable large employer, do not meet these responsibilities to offer ACA compliant coverage? Well, there's two different penalties, penalty A and penalty B. Penalty A is assessed whenever the employer fails to offer minimum essential coverage. Now, the yearly penalty for a penalty A is $2,700 times all full-time employees, but the IRS will say, hey, we'll give you a break when we make this calculation. We'll take away the first 30 full-time employees and assess that dollar amount on the rest of the full-time employees after the first 30 full-time employees. However, the IRS looks at these on a month-to-month basis. So in reality, the IRS will assess this at $225 per month per full-time employee minus the first 30 full-time employees if minimum essential coverage is not offered in that month. Penalty B is assessed if coverage is either not affordable or does not provide minimum value in a given month. The yearly penalty for that is $4,060 per full-time employee that receives a premium tax credit from the exchange and is now offered affordable or minimum value coverage. But this is calculated on a monthly basis at $338.34 per month for each full-time employee receiving a premium tax credit from the exchange and that did not receive affordable or minimum value coverage. The only thing that will ever trigger these penalties is if you, the applicable large employer, fail to meet your responsibilities here, and this is the big end, an employee goes to the exchange and gets a premium tax credit. Either penalty may apply in a given month, but not both, and penalty B cannot exceed the amount the employer would have owed if it had been liable for penalty A. These penalties increase to $2,750 for penalty A and $4,120 for penalty B in the 2022 tax season. In addition to offering coverage that meets ACA standards, applicable large employers are also responsible to report on their offers of coverage annually to the IRS in order to determine the applicable large employer's compliance with the employer mandate, including assessing any non-compliance penalties for the applicable large employer for failure to meet their requirements under the employer mandate. And it's also for the IRS to check an employee's eligibility for a premium tax credit on the exchange, either for not being offered minimum essential coverage by the applicable large employer, or because coverage was not affordable per one of the three safe harbors we went over, or because the coverage did not provide minimum value. In addition to applicable large employers, employers of any size with a self-funded plan or an ICHRA also have to report annually to the IRS. That's because in these different type of plan options, there really isn't a carrier involved to do the IRS reporting to prove an offer of coverage. That an individual held minimum essential coverage during the tax season. So that will fall on an employer that sponsors either a self-insured or an ICHRA coverage. Some important deadlines coming up for the 2021 reporting season. Remember, we report our 2021 tax information in early 2022, much like we do our personal taxes or our employer taxes We also, when we do our IRS reporting for ACA, we do it in early 2022. So I want to focus your attention to the last three columns here. If we're copies to employees, either 1095B or 1095C, are due on or before the last day of January 2022. Paper submission to the IRS is due on or before the last day of February 2022, and electronic submission to the IRS is due on or before the last day of March. And important to note here, if you're filing 250 more returns to the IRS, you have to do so electronically. With all that we've done over here today, I want to finish by saying that documentation is extremely critical. IRS audits on this type of information come down the line 3 to 4 years later on down the line. So it's important to keep employee waivers on hand, any sorts of documentations of offers of coverage, affordability determinations, group size calculations, maybe even consider you doing all this under an online enrollment solution where you can generate reports at a click of a button. Our recommendation, store these records for up to 3 to 6 years. Like I said, IRS audits come way down the line. And it's not always because you, the employer, did something incorrectly or failed to do something. The IRS makes mistakes too. So it's always good to have documentation on hand to prove that you did meet your responsibilities under the ACA's employer mandate. And with that being said, we want to thank you so much for your time today. From the Word & Brown General Agency to you, the employer, we want to thank your brokers for inviting you over today. It's without that partnership, we couldn't do what we do in order to simplify access to better health options for employers and employees. We really hope the information in this video was super helpful to you. We have a Don't Fear the Forms presentation coming up that kind of goes over the ins and outs of the ACA's employer reporting process in December of 2021 and in January of 2022. So look out for an invitation from your broker. We hope to see you there. Again, my name is Rene Gonzalez, a Senior Compliance Analyst for the Word & Brown General Agency. Have a great day.